The Dow Jones Industrial Average fell 465 points shortly after the markets opened this morning. But an emergency interest rate cut by the Federal Reserve before the markets opened may have helped. The emergency rate cut is the first in September 2001 and is the biggest in more than 23 years. Sun-Times columnist and financial analyst Terry Savage is here to tell us what this all means for the stock market and for everyday folks. Terry, welcome, and I guess it could have been worse.
It could have been a lot worse, and it looked like it was going to be a lot worse early this morning because we had, of course, our markets on a holiday yesterday, and so there were 2 days of Asian markets falling, and many of them 8% one day, another 8 or 9%, so 15, 16% on some of those markets ranging from Hong Kong to Australia to India and then Europe.
And these things have a way of taking on a life of their own. So this morning, explain what the Fed did and why they did it.
Well, the Fed realized, I mean, what the markets around the world were saying is, America, you're in recession, even though we don't want to acknowledge it, and the president didn't, and the Fed chairman was saying, no, it's just a little bit of a slowdown. The rest of the world said, you know, your consumers are tapped out. They've tapped the piggy bank of home equity dry. They're loaded up with credit card debt. And when they realized that American consumers, the leaders of the growth engine, were not going to be buying anymore, that's bad news for their business. I mean, they make money by selling stuff to us. So those stock markets around the world started falling and falling. So that was where we were when the Fed needed to do something dramatic, and it did, a 75 basis point cut.
Okay, a dramatic step, and as we said, it could have been worse. So did the dramatic step work?
It worked temporarily. The markets sold off at the beginning, came back. We're still down for the day. I just checked the Asian markets. They are opening with a bit of a bounce, but they're still down, many of them, you know, double digits from 2 days ago. The problem is it's very difficult for the president and the Fed to fix the economy because the economy has so much debt and so much of it is held by these very foreigners who have been accepting our dollars for years. We buy stuff. We buy towels from China, bath towels, I love those, and we buy oil from the Middle East. And they've had all those dollars, they keep investing them to lend us money to cover our debt, treasury bills, notes, and bonds. Now you got the Fed saying, we're going to cut interest rates. Well, my mom gets annoyed when rates go down. Think about these foreign central banks. Then they don't want dollars. Or if the president says, we're going to give you all money back, a check, whatever it turns out to be and who gets it. We have to go into more debt to do that. So they look at our national debt. They look at our trade deficits, and we don't have as much flexibility to pump up the economy. And you saw that, just to finish up, in the gold market today. Gold is up, the dollar is down. The world's a little bit scared about America's ability to fix itself. And
you said you were already paying attention to what's happening in the Asian markets. Okay, so what are you expecting to happen tomorrow here in the United States?
You know, it's really hard to tell, Phil. I don't call the markets. Overnight, we'll see what goes on in the other world markets. But we haven't really fixed the problem, and I'm not sure 3/4 of a point will do it. And it really forces investors now to think about, gee, if it was really down a lot, how do I feel about my investments? You know, we've got a generation of baby boomers and those following who never saw that they had to manage their finances and their retirement accounts. Our parents had a pension check for life. The professionals managed it. Now we have to conquer our emotions, do a little bit of thinking about how exposed you want to be to the stock market. You know, I'm always a big fan of the market over the long run. But if you're close to retirement and you're not going to keep putting that $300 a month into your retirement plan so you get the bargains of low-price stocks, then you need to think about maybe diversifying a little bit.
And when you say close to retirement, give me some, how close to retirement are you talking? Are you talking about 5 years? Are you talking 10 years?
Well,
are you talking 15 years?
There's never been a 20-year period when you would have lost money in a diversified portfolio of large company stocks with dividends reinvested, even adjusted for inflation. I'm going to say that all the time. That's a fact. There hasn't been a 20-year period going back to the 1920s. Now, the day you retire, you don't want to be out of the stock market because you need growth. And if there's going to be inflation, stocks will help you beat that inflation. So nobody's going to be completely out of the market. It's just that we're being tested now as investors to have a plan, have some self-discipline, and stick to it. If you're in your 20s, 30s, 40s, and early 50s, you're going to stick to that diversified stock investment.
Terry, I heard an analogy today from an economist who said that the economy is sort of like this marble column. And all of a sudden the marble column starts to tilt a little bit, and if you catch it at the right time, before it tilts very much, all you have to do is sort of push it back. But if you wait too long, it's not enough to push it back because the column will fall. Has the Fed done what it takes to keep that column from falling?
Interesting analogy, but the question isn't whether the Fed has done that. I'm going to send you to a wonderful website. In fact, I'll have you get Sheila Weinberg, who created truthinaccounting.org. They have a new website, Truth in 2008, Truth in 2008. On the top is the national debt.
Sounds like a political website.
No, no, it's actually, it's to get all of the politicians to think about this. It's nonpartisan, truthin208.org. There's the national debt, $9 trillion and counting. The way they calculate it, the national debt is more like $55 trillion when you add in all the promises we've made to the future, to Social Security and Medicare. How are we going to tax our children to pay for that? This column is more than just tilting. It's a serious, big problem that our politicians need to address, and very few of them are talking about it in this election. Okay,
one of the things they're not talking about, they're not willing to use the term recession yet. Let's assume the worst case scenario for now. Say there is, that we're in a recession. We may not know officially that we're in it until months down the road, but if there is a recession, how should people behave differently than if we're not in a recession?
Well, let me say this. It's not your patriotic duty if you get a rebate check to go out and spend it on something new. There will be some people that need to spend those rebate checks just to keep up with their heating bills, and others who are in debt who should be paying down debt. Right now, we have really low unemployment. There are jobs out there. Recessions typically, you know, you get statistics about unemployment. So right now, even if it's not what you do, you're a salesperson or a young executive, go get that weekend job as a waiter or a waitress, do something else. Pay down the credit card debt. That takes a huge burden off of you. If you've got a mortgage and you still have equity in your home, the home price will stand for it, then refinance. The Fed is pushing rates down, can do it temporarily. You get a lower fixed rate mortgage. This is the time to be, I know, you're going to tell me, Phil, that if I tell everybody to be conservative and not go shopping, I'll guarantee a recession.
Right, okay? As caused by Terry Savage.
Yeah, exactly. And I worry about that, but the fact is, I'm here to talk to you about your money. And I think if everybody does a sensible financial thing of living within their means, cutting back a little now, not being burdened with debt, if you can do that now, we'll all be better off in the long run.
All right. We're almost out of time, Terry, but is there any other point you want to make to just, the average person, not the Wall Street mogul, not the captains of industry, not members of the Fed?
I said this on the front page of the Sun-Times today. Nobody ever got rich betting against America. There are some scary times. There have been times when the market is down and stayed down for a while. Over the long run, that long blue line that represents the stock market, that represents the American economy, has always marched upward. There have been scary times in the past. All the people that got out in 63 or in the crash of 87, when the Dow was around 2,000, think how silly they feel with the Dow still at 12,000. So if you have the long run perspective and you're responsible for your own future, you need some exposure to stocks. Just don't panic. That's the other thing. Don't panic. Think about it tonight.
All right, Terry.
And don't panic.
I feel calmer already.
Good, I'm glad.
Thank you very much, Terry.